Hello guys, let's go. For example, a stock might be underpriced because the economy is performing poorly and investors are panicking and selling. Or a stock might be overpriced because investors have got it too excited about an unproven new technology. Psychological biases can push a stock price up or down based on news such as disappointing or unaccepted earning announcement, product recalls, or ridicule. Stocks may also be undervalued because they trade under the radar, meaning their inequality covered by analysis and the medium. Down follows the herd. Value investors process many sharpers of contraries. They down follow the herd. Not only do they reject the efficient market hypothesis, but when everyone else is buying, they're often selling or trading back. When everyone else is selling, they're buying or holding. Value investors don't buy trendy stocks. Instead, they invest in companies that aren't household names if the financial check out. They also take a second look at stocks that are household names when those stocks prices have plummeted, believing such companies can recover from setbacks if their fundamentals remain strong and their products and services still have quality. Value investors only care about a stock's intrinsic value. They think about buying a stock for what it actually is, a percentage of ownership in a company. They want to own companies that they know have sound principles and sound financial, regardless of what everyone else is saying or doing. Value investing requires delicious and painful. Estimating the intrinsic value of a stock involves some financial analysis, but also involves a fair amount of subjectively, meaning at times it can be more of an art than a science. Two different investors can analyze the exact same valuation date on a company and arrive at different decisions. Some investors who look only at existing financial don't put much faith in estimating future growth. Other value investors focus primarily on a company's future growth potential and estimate cash flows. And some do both. Noted value investment gurus Warren Buffett and Peter Lynch, who ran Fidelity Investment Magellan Fund for several years, are both now for analyzing financial statements and looking at valuations multiples in order to identify cases where the market has mispriced stocks. Despite different approaches, the underlying logic of value investing is to purchase assets for less than they are currently worth, hold them for the long term and profit when they return to the intrinsic value or above. Okay, like all investment strategies, you must have the petitions and the license to stake with your investment while shopping. Some stock you might want to buy because the fundamentals are sound, but you'll have to avoid if it's overpriced. You'll want to buy the stock that is most attractively priced at the moment, and if no stocks meet your criteria, you have to sit and wait and let your cash sit idle until an opportune arises. Why stocks become undervalued? If you don't believe in the efficient market hypothesis, you can identify reasons why stock might be trading below their intrinsic value. Here are five factors that can drag a stock's price down and make it undervalued. Market moves and herd mentality. Conversely, when a stock's price is varying or when the overall market is declining, loss aversion compels people to sell their stocks. So instead of keeping their losses on paper and waiting for the market to change directions, they accept a certain loss by selling. Such investor behavior is so widespread that it affects the prices of individual stocks, exhibiting both upward and downward market movements, creating excessive moves. United and Anglo stocks. Look what you're behind in the news. You may find a really great investment opportunity in undervalued stocks that may not be on people's radars, like small caps or even foreign stocks. Most investors focus in on the next bite, things such as a technology startup instead of a boring, established consumer durables manufacturer. For example, stocks like Meta, Apple, and Google are more likely to be affected by herd mentality investing than conglomerates. Bad news. Even good companies face setbacks such as digital and relax. However, just because a company experiences one negative event doesn't mean that the company isn't still fundamentally valuable or that its stock won't bounce back. In other cases, there may be a segment or division that puts a dent in a company's profitability, but that can change if the company decided to dispose of or close that arm of the business. Analysts do not have a great track record for predicting their future, and yet investors often panic and sell one company and also earnings that are lower than analyst expectations. Okay guys, bye bye.